to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, excuse me. Welcome back. I've got with me in the studio today, Mike Cejer.
Hi.
Mike,
How's it going?
Good. Thanks for coming back in, Mike. And we got a lot of stuff to talk about today. And if you'd like to ask a question, you have a question for us, you can call us at 216-901-0945. That number again, 216-901-0945. And I had a request this week by someone who had attended one of my prior workshops, and she asked that we would cover that material again. And that's one of the reasons I brought Mike on, and one of the things we're going to be doing together is a website that will offer a lot of this education as part of an ongoing subscription package, as well as some occasionally an individual stock recommendation and updates on markets, which stocks are moving, lots of different stuff, and it's going to be called Look Out for the Bull. So some of you may recognize that are longtime listeners, and so I'm really looking forward to that, and I do see the phones are lighting up already. If you would like to call us, 216-901-0945, and I'm going to go right to the phone now. I got George. George, you have a question for me?
Yes, Bill. Thank you for your show. I always enjoy listening to you.
Oh, thanks.
First of all, I'm a retiree.
Okay.
And then I'll declare I'm a Republican. And we've enjoyed these good returns the last 2 years.
Mm-hmm.
And my fear is if people don't support the Republican Party and all this positive energy, what do you think will happen to the market? And
interesting.
That's my question for you.
That's an interesting question because way back in the day, when I was an econ major, and Mike Cejer, by the way, the guy sitting here next to me, he's an econ major. He goes to Case.
Yes.
So way back in those days, we learned that the most powerful and the most effective form of government, now this is going back to the 80s, so I'm not sure if this is still true or not, but the most powerful form was when there was a balance, when one party held the presidential office and the other party held majority in either the Congress or the Senate. So they got more done in those time periods. And despite what Trump's personal appearance might be, or how he appears, his personality to the general public, I'm pretty sure he's a deal maker. Just watching what he's done, so I don't think it'll be all that different if they lose control of one of the either the Senate or the House. But that's my own personal opinion. I don't think there's going to be a huge change because, yeah. I think
what I like to say, Bill, is you don't have to like Trump as a person or what have you, but I'll tell you what he's doing for the country, the employment, almost a 50-year low. That puts me back in high school. When I came out of high school, those were the best of times.
Yeah. Well, George, I'll tell you, I'm glad to hear you say that, because I say that all the time, and it just makes some people really mad.
It makes them mad, because things are good and people are working.
Well, no, because
you take someone off the government dole, and it builds their self-esteem.
Yeah, well, it absolutely.
Them a better person.
Yeah, yes, and I see what I say is very similar to what you're, the feelings that you're expressing, are that I'm for the person or people that I think are going to do the best for the economy, because when people have money, just like you just pointed out, they tend to be happier. The crime rate absolutely drops. By the way, there is a correlation that can't be argued, that crimes drop in times of economic expansion. So that's another one of those things I learned, a long time ago before anybody had a computer.
Well, thank you so much, and I'll listen to the rest of your show.
All right. Well, thanks, George. Have a good Saturday.
Bye.
Bye. If you'd like to call us, 216-901-0945. Yeah, that was pretty interesting. Back when I was in college, and what I thought was really funny, I had this professor, econ professor. He was his name was Charles Register. And I'm not sure how old he'd be today. I think he was 27. He was a full PhD, and this was not the first school. Kent wasn't the first school that he was teaching at. So he'd been at it for a couple of years already. So to have your full PhD in economics and 2 to 3 years teaching under your belt by the time you're 27, that dude was like off the charts.
Very
smart.
Impressive. Yeah.
And he was explaining how the president appointed the head of the Fed. That wasn't a thing that was voted, and he was saying that it was independent. They don't really adhere to a political party or an agenda. They're there, and I was asking him when they got appointed and the time period. I can't remember what it was, but it came up, and it was near an election time. And I go, so you don't think the president being able to appoint the head of the Fed would have anything to do with his reappointment? He goes, oh, no, they would never do that. And I go, yeah, right.
Well, I do have to say, people put a lot of stock in the president having a lot of control over the economy.
Right.
I think it's more the people that they appoint.
Oh, it is.
Yeah.
The most powerful person on the planet is Powell, because he's the head of the Fed.
Mm-hmm.
When you hold the purse strings on the economy that's the largest economy in the world,
mm-hmm.
then yes, you have way more power than the president does. And I think it's kind of funny that I'm not sure Trump was aware of that.
There's a lot of things he's not super aware of, but I think he's appointed some people that have
done very well.
Very, very well, yeah.
Yes. Yep, absolutely.
I know I've done a lot better in what I've been investing.
Yeah. Yeah. And it is. I don't know. I thought Mitt Romney had a phenomenal, if you looked at the economic plan he laid out, wow. If that had been, if even portions of it had been adopted, and so that's the other thing. The partisan stuff, they get so obstinate. I'm sorry. Maybe abstinent too. I don't know. But they're obstinate. Maybe that's why they're so grouchy. I'm just kidding. But they're so obstinate that they shoot down everything that the other party says, and that is just not good. That is not good. We're still all Americans. We still need to help each other because nobody does anything by themselves. Boy, the better you get along, the better things go. You don't have to agree with anything everybody says. Wait till you get married. You'll find that out. Lickety split. Just remember, happy wife, happy life. I wish I'd have learned that lesson. Anyway, I'm just kidding. But yeah, the economy is actually in very good shape right now. Unemployment numbers are lower than they've ever been. They have set records, but they've changed how they calculate the unemployment rate.
Yeah, the unemployment is very, very tricky. We've covered that in some of my classes. My first year taking econ courses, and there are about 4 different ways to calculate the unemployment that vary very greatly.
Yes. Oh, and here's another thing, Mike. I'm telling you right now, by the time you can collect all the data that you'd like to have, it has all changed. You've got 330 million people in this country by itself, and we are affected by foreign countries because we do a lot of importing and exporting.
Mm-hmm.
So by the time the data is actually calculated, it's all changed. Just think about it. I mean, Walmart is one small, tiny drop in the bucket if you look at everything, the entire economy. And I forgot, I think Walmart has over 10,000 locations. And out of 10,000 locations, there are at least 10 registers, probably closer to 30 or 40. I don't know. It depends on the size of the store.
Mm-hmm.
But if you just said they only had 10, so what's 10 times 10,000? That's 100,000. You have 100,000 cash registers spread out in every time zone, ringing as much. They can't calculate what they've done in a day for at least a month or so. It takes an enormous amount of time to gather all this stuff. So that's what I also thought was kind of funny about econ. Back in when I was taking it, it was known as the dismal science. I don't know if they still call it that.
It still is, yeah.
Yeah, it's because it's incredibly difficult to gather data. The data, by the time you do gather the data, it's already changed. And one of the leading stock market or leading economic indicators, actually, that the Fed uses are stock prices. They feel as though, or at least they did. Again, I'm talking about stuff that happened, way before you even thought about being born. But the stock market, there are people closer to the actual sales at the major companies, and they know what's going on. They start acting. Other people start following suit. So the stock market has a tendency to move before the actual economic indicators move. And that's I thought it was a riot that the Fed is looking to the stock market for guidance.
Cart before the horse.
Well, actually, they were saying, there's some people that are waving a carrot in front of that horse. They're dangling the carrot, and they're closer to that horse than we are. And that's what they're trying to do. But anyway, so we got a seminar coming up. I got the date, and I can't remember what it is. So actually, you'll have to check my website to find out, and that's bullingtoncapital.com. And it's going to be an educational. I got a request from somebody, and I was talking to Mike about this before the show. We got a request to do a seminar to basically go over the basics of investing, actually stock picking. And I if you never plan on picking stocks, you should learn how to do it anyway, just so that you don't get taken advantage of. That's kind of it's self-protection. And by the way, there are a lot of people that you look at my industry, they've made it so complicated that you get a bunch of people participating in the industry who basically memorize everything that they're going to have to know on a test. And they'll never use a lot of that stuff. And then in reality, a lot of it doesn't work exactly like it shows up on the test. Mm-hmm. So if you haven't really drilled down into the essentials and get those down really well, it's very easy to miss.
Yeah, there's a big gap between book smarts and experience.
Yeah. Oh, yeah. Knowledge is great. Knowledge accompanied by experience, a lot better. You get to see, assuming that you learn. Some people repeat the same mistakes there in
right.
very long time periods. But but if you're learning, I think it's really good. And it's one of the things Mike and I are working on. We're working on the Lookout for the Bull site. We'll be able to get that up sometime soon. And it's probably going to go through several iterations, I would think. Maybe we can even put up we could put up a bare bones one and then add to it later. Mm-hmm. That might be a good idea. Because that stuff it's fascinating. And when I look at the scans that we're going to be putting up on there, I just ran the scan, and it's amazing how out in front some of this stuff can be. A couple weeks ago, a whole bunch of retail stocks, and retail has just been beaten, for a ton of reasons. Mm-hmm. Most people are afraid that everything's going to go online. Well, most retailers have online stores now. I get something every day from the Gap, and I'm pretty sure the Gap probably spends less money on their website than they do on the retail stores. And I think with clothing in particular, it comes down to you have to try some things on. I don't know if your body's anything like mine, man. Mine is abnormal. I can't. I have to try stuff on because it just doesn't fit right off the rack. So, and I can't imagine doing that. At some point in time, I can imagine it, but we're a long way off from this yet. At some point in time, you're going to stand in front of the device like how Microsoft has that piece of equipment that puts you in the video game?
Oh, yeah.
Okay.
Yeah. Kinect.
Yeah. So that can measure you. They already have that technology's actually been around since the 80s. Mm-hmm. They could measure you. In fact, Levi's tried to do this in the 80s. They had these devices that you would stand in front of it and turn around, and it would measure you with laser, super precise, and then they would make clothing specifically for you, for your body type.
That's funny you bring that up because there's actually a company, and I can't remember the name, but you take a picture of yourself, just you're standing up, full body, from the front and from the side, and they send you custom shirts that are supposed to fit you perfectly. And apparently, I've never tried it myself, but apparently it works. I don't even need to scan you.
Yeah, well, that's cool. I just know that's coming. It's kind of like we're in the 70s, and Timex is rolling out those really crappy computers that you plugged into your black and white television. Yeah, and now you look at a smartphone, and it just blows that away. So I know that day is coming at some point in time, but that's not anytime real soon.
Right.
But in the meantime, clothing is one of those things where, you almost have to try it on. And I can't imagine that the profit margins on clothing stores are so high that you could afford to have a bunch of returns that people ordered online that didn't fit or they didn't like it, didn't look like the same color they saw in the store. That's one of those areas where I think the stores still probably have a good 10 or 15 years left before they're actually, everybody's doing the bricks and clicks, and the stores are going to get fewer, farther between, and you'll do a lot of the stuff like the measuring standing in front of it.
Well, it's kind of interesting you talk about that because we had an industrial revolution, especially with Ford, where they revolutionized, let's make a lot of one thing.
Right.
And we're kind of on the cusp of the personalized revolution.
Right. Yeah.
We're going to get, this is designed for me specifically, which is really cool.
And let me tell you, all you all you programmers out there, when you're doing this and you're doing women's clothing, you need to label that stuff like 3 sizes smaller than they actually are if you want to sell a lot of it. I'm just kidding. It's just a joke. But realistically, those days are coming. And when I see, the reason I bring this up is there were a ton of stocks showing up on the scans this week that were in retail. I mean, a ton of them. And we had talked about Under Armour, I don't know, a little over a week ago. It had come up on a scan. And of course, a couple days after I talk about it, it goes down. But that's what they do because they're stocks. Anyway, one day last week, it was up a little over 25% in a day, one day. And these are the types of stocks that come up on the scans. Under Armour was something I understood. Right now, its price to sales ratio is still at a 35% discount to, actually, it's more than that, 35%. It's at a big discount to Nike. And Under Armour is smaller than Nike, but their profit margins are pretty similar. So is Nike really worth paying all that much extra for? And at some point in time, I can't imagine somebody not trying to take these guys out, just trying to buy them. So in other words, what I'm saying is it comes up on a momentum scan. That's how it came to my attention. But then I look and it's got a good business, but we're going to have to talk about a little bit. We'll talk about this when we come back from these commercial messages. Listen to Bill Bullington, Mike Cejer right here on the Bullington Capital Report. We'll be back after these messages.
And the enemy is right up in your face when your back's against the ropes and you're feeling all alone. Keep fighting the good fight. Never give up. Never keep letting your light shine. It's times like these when I fall so hard that I wonder now.
And we're back. Listening to Bill Bullington and Mike Cejer right here on the Bullington Capital Report. And we were just talking about the basics of stocks and why we're going to have a seminar to talk about that and why you should know that. Before the show, Mike and I were talking about how long it takes to get a driver's license.
Oh, yeah.
Right? All the work that involves. And people will let them take their financial lives into their own hands with no training. And you have to take 2 tests, one written, one you have to get in the car and drive, and you have to practice for 50 hours before you can drive a car. And I think that should be a requirement from junior high. You do this for kids with investing. Realistically, it can be taught at that age, no sweat, and the kids have enough math already by the time they're in the 6th grade to actually understand it. And I know this for a fact because I went to a couple of schools, elementary schools, and gave them a presentation. The kids were eating it up. They were advanced. It was an advanced class, and I think they were either 5th or 6th grade. But boy, they just jumped right on that. And it's interesting. They don't have a lot of baggage, by the way, psychological baggage that people carry with them into the stock market. They have an idea of how they wish things would work, and sometimes that materializes as how they think it's actually going to work. And that can be pretty tough, to find out that, it doesn't really work that way. In fact, stocks are really counterintuitive. I mean, it just blows my mind, even to this day, just how counterintuitive they really can be. Look at a company that you think is a great company, it's got great price, and the next thing you know, it's down 50%. You know? So if you're not prepared for that, then somebody didn't prepare you for stocks.
Right.
And that's one of our goals at Bullington Capital is kind of to do that educational process so that next seminar we're going to talk about it. And there's a thing I talked about called the 60-second test. I wrote an article about it, put it up on a website a long time ago. And I'm going to bring that back, but I'm going to modify that because I think I've found an improvement on it. And it's the Bullington Capital Value Model, the one where we take that measure of cash that the company is generating, and then we divide that by the cost of buying the whole business, and it converts it into a yield. So now you can compare it to a CD. You can compare it to, there will be a million people, by the way, over time that hear this, that say, yeah, but and they've got these, we understand. See, what we're doing is we're not trying to get this perfect yet. This is a screening tool so that you don't have to waste your time. If you had to look at all, several thousand stocks that you could potentially invest in, and if you look at the small, super small cap and micro cap, now you're looking at probably more like 5,000 or 6,000 stocks to have to examine. You will never get through. You'll never be done. So if you know what these things are they perfect? No, it's like a sieve. You have a sieve, some stuff gets through, the bigger, harder stuff doesn't. And that's what we're doing. We're going to narrow down the list of choices that you have to those that just have the highest probabilities of working out in the future. And there are a couple different ways that we're doing that. Look out for the Bull is actually going to start with the price movement model. We're going to look at price movement, and that's the key determining factor to our buying and selling decisions. Not the only factor, but it's the key factor. There's a reason for that, and we'll explain that at the workshop. Eventually, we'll be talking about the value model, which is really more in line with traditionally what people thought that they should probably do is buy low and sell high. But nobody tells them what low is. When is a stock price sufficiently low? I don't know. And in fact, I'll look up a couple examples during the next commercial break, if you'll remind me.
Mm-hmm. Will do.
Of companies that went really low and then got really, really low. Companies that you will recognize. You'll recognize these names. So there's a lot to be said, I think, for both methods. The ones that went really low right before they went really, really low would not have qualified under the Bullington Capital Value Model because they weren't generating enough cash to support that low price that ended up getting even lower.
Right.
Now, at some point in time, they did. They got down there, and now they've moved up again. Okay, so perfection is the enemy of profitability in the stock market. If you're striving for perfection, that's going to hurt you. You've got to have some wiggle room in there. You've got to let things take place. You handle that risk of not being right every time by diversifying. That's how you handle that risk. You're not going to avoid the risk. Avoiding the risk means I'm not going to invest. Okay. Handling the risk means I'm going to do some smart things so that I can take the risk and I can invest in a stock, and not every stock has to work out perfectly for me to still come out way ahead.
Right.
And so that's kind of our goal. And just looking at the price movement model, that's where the Under Armour came up when I talked about it a little over a week ago. And immediately, it goes down. But it didn't go down very far. And it went down for actually a few days in a row. And then all of a sudden, bam, one day it's up 25% in a day. And I would love to say that was skill. Sorry, that was just probability. That's all it was. It wasn't really skill. And it was there was some luck involved too. Had I not noticed it, I wouldn't have talked about it. And hopefully somebody out there bought that thing. That would be kind of cool. But that's typically what happens when you're doing a website like this. You'll get people that do buy stuff that comes up on it. And boy, you get one of those big home runs. That's not a big home run, by the way. 25% a day is not that's not the biggest I've had. It's nice when something like that happens, especially when the company's undervalued. If it's undervalued and the price is moving, now the odds have that the probabilities have gotten much higher. If it's moving fast, but it's overpriced, the probabilities aren't quite as good that will keep going. A lot of those stocks will just keep right on going. There's some cannabis stocks. I can't remember what it was. Tilray. I don't know if you've heard that or not. I had several people calling me and asking me about it. I'm like, yeah, no, they don't have any sales yet. You're not investing in a real company there. You're investing in a business plan.
An idea.
Yeah. And a lot of people put a lot of money behind that business plan. So I hope that they get some sales and can generate some profit before they run out of the money they raised. Occasionally, people will raise even more money before they get sales, before they get profits, and eventually some of those stocks will go on to do very, very well. But that is a lot riskier than buying a company like Under Armour, who already has a brand name, already has a bunch of products, has a bunch of sales, and a bunch of profit. Those are the differences. And it's as simple, it literally is as simple as that. One of the things I liked about Warren Buffett and Peter Lynch, they spoke very simply. There was this guy, John Neff, he was from Cleveland, actually worked for National City Bank. And he managed, I can't remember the fund. He managed the fund for Vanguard. Vanguard came and picked him out of and had him put him in charge of this thing. And at the end of his career, he was his track record was 13.5% versus 9% for the S&P 500. Most people don't think that that's a lot. That's actually 50%. It's 50% better. 4.5% increase is 50% of 9. So he's actually 50% better. And get a calculator sometime. Put over 20 years a 9% return and then a 13.5% return and see what you think. Okay.
Nothing to sneeze at.
Yeah. It was because of the time he was investing and managing the money, the markets weren't doing very well. For a large portion of that time, they weren't doing well at all. So for him to be able to retire with that kind of track record, that is awesome. It's amazing. And those guys were so low key. And they talked in terms that almost anybody could understand. And it's actually one of the reasons I gained a pretty good understanding myself. It was guys like that. They were out there and they were putting stuff out there and they're trying to talk. And I know if you're brand new to the industry or if you're just out of college or maybe you're in college and you're studying for the first time, you're going to hear some terms that you might not recognize. Just go to Investopedia, look it up. Over time, it's going to make much more sense to you. And the basics are really simple. In fact, both Peter Lynch and Warren Buffett used the same quote, and it was, invest in a stock that any idiot can run because eventually one will. And I thought it was kind of fun. I know what they meant. They weren't being facetious. I mean, they were lighthearted. They were not attacking anybody, but they were just saying simple businesses tend to be more profitable, easier to run, and end up performing better in the long run. And I would have to agree. After all these years, watching that, trying to take that into account, I even went so far as to, if I couldn't tell what the business was doing and I'd already spent 15 minutes on their website, you got to go to another business. That one's too hard. That is way too difficult. And so that makes most companies that buy a bunch of other businesses not all that attractive. Or if they're in a bunch of different business lines. One of the problems I think GE has is they've got a bunch of different business lines. A few of them went bad, and they're dragging down a lot of the more profitable businesses there. And that's a risk. Peter Lynch called that diversification instead of diversification. The companies would decide to diversify their income streams. They would have been better off buying shares back and increasing their dividends so that they reward the shareholders rather than investing in businesses that end up costing them money and actually threatening their existences. That's really rough. So all that kind of stuff we talk about, and one of the stocks that came up on the scan is Tempurpedic. It's called Tempur now. I was looking at the word. Sealy and Tempurpedic actually merged.
Really?
Yeah, one bought the other one. And I remember when the Tempurpedic was first coming out, it was all the rage. Boy, that stock just flew. It got to a point where it was not underpriced by any means. that you could imagine. So if you liked it and you liked sleeping on the mattresses, and people that really like being really warm at night, love those mattresses, that stock went from $83, and actually here in 2009, it goes from a low of $5 to $83 in 3 years. 3 years. Whew. And then in 2012, it got all the way down to 20. So you went from 9 to 83 to 20. You know what? I mean, I don't know. I mean, that's enough to drive someone crazy, especially if you loved that product and you bought a bunch of it and you held on to it and you didn't know when it was overpriced and when you might want to take some profit out of it. So those kinds of things are not that hard to learn. They require discipline. That's it. And when you look at the math that we're going to be showing on how to pick these stocks, how much to put in them, when to sell them, I think it's so much easier. Is it going to be perfect? No, absolutely not. You can't be perfect in the stock market. And if you've ever had a girlfriend or if you've ever been in a serious relationship, you already realize you're not perfect. That's a corny joke. Sorry about that. But you really can't be perfect in the stock market. It is really difficult to do that. And the goal is not to be perfect. It's to be profitable. Mm-hmm. That's the goal. Don't try to be perfect. Just try to be profitable. Give yourself a fighting chance. And one of the great things about having a young guy around is this is like the first time he's ever heard a lot of this stuff. I know a lot of you guys are probably going to another station right now that are long-term listeners because you've heard it so many times. But it hasn't changed. It's the same stuff. Some stuff has changed. In fact, the way that these stocks move today, they're a lot faster in both directions. Both directions are a lot faster. I remember when I first started this, I mean, that was like watching paint dry. It was, or it could be. It could be, most of the time it was like watching paint dry.
Yeah, volatility is the name of the game today.
Yeah, and it's been increasing, and a lot of that's because of the computers. So there are ways of dealing with that. And if you make the adjustments, I think you're going to be fine. I think the economy is going to be really fine. I think I forgot to give out the phone number again so you guys could call and ask questions. So it's actually 216-901-0945. 216-901-0945 if you want to call us there. If you hear something you want to call in. By the way, here's another thing I really like to simplify for people. It's called retirement planning. You are never too young. If somebody had told me when I was 12, if somebody had told me this, I promise you, I would have understood it, and I would be doing something different right now. I think. I don't know. Maybe I probably just have one fund instead of managing multiple accounts. But yeah, because I really like what I'm doing a lot. But at 12 years old, you're old enough to understand these concepts. So you can bring your kids. I think it's a good idea. I'm going to try to break it down so that you can memorize some of it. And by the way, you will be memorizing a lot of stuff. It's just the parts that you can't memorize, that can't really be described, are the things like invest in a company that any idiot can run. Well, what does that mean? And we're going to talk about that at the workshop. We're going to talk about how you can deal with that, even if you don't know anything about stocks whatsoever. Okay? Or if you're a seasoned pro, there's probably going to be some stuff there for you, because I've been doing this a long time, and I'm sure there's people that are doing things that are in the industry as long as I've been, that have been doing different things. There's going to be a lot of things they know about their specialty that I don't. Okay, so now they heard the music. That means we got to take a real quick commercial break. You listen to Mike Cejer and Bill Bullington right here on the Bullington Capital Report. We'll be back after these messages.
Seems like all I could see was the struggle. Love the Lord your God with all your heart, with all your soul, with all your mind, and with all.
And we're back. Hey, listen, if you'd like to call in, we got about 15 more minutes here. The phone number is 216-901-0945, 216-901-0945, and you are listening to the Bullington Capital Report. I am Bill Bullington. I'm here with Mike Cejer.
Hi.
And we were just talking about an upcoming seminar. It's not even up on my website yet. It'll be up probably on Monday. And we're going to be covering the basics of investing in stocks. The reason that we're doing that is it was requested, by the way, by someone. And I think it's really important that you have the information, even if you never plan on using it. Knowing how to do it is going to make you a better investor. It's going to make you a better client. You'll understand more what your financial advisors are telling you. You'll get along better. You'll feel better about what you're doing. And hard to put a price on that, but I'm going to. It's called free. The seminar is completely free. And you just, again, it'll be up on either Monday or Tuesday. And feel free to sign up for that or call and learn more about it. And Mike requested, during the commercial break here, I would talk about the actual formula for the value-oriented model that we'll be publishing at some point in time. And I think that's probably a good idea. And so the formula, and incidentally, not only will it be up on the website, every month, if you were starting, you're going to start basically the first of a month. If you were starting, we're going to update that list so that if you're starting that month, that you could get started with those stocks. Now, you could start anytime during that month. Your returns are going to be a little bit different than somebody that started on that actual day. But that's okay. And then every 6 months, you're actually going to update and rebalance that. And you're going to use this formula that I'm going to talk about right now. And the formula is not magic. It's basically very practical when you take a look at it. You're taking a measure of the company's cash flow. It's called EBIT, earnings before interest and taxes. And you're going to divide that by the cost of buying the entire business, which is called enterprise value, or EV. Now, if you don't know those things, do not try to write this down while you're driving. We will cover this a million times, so don't worry about it. It'll be up on the website. It's going to be we're going to have some articles about it. And what you're doing is you're converting a stock into a yield so that you can compare one stock to another. And the idea being that you'd probably like the ones with the highest yields. And we'll be talking about that for a very long time because it changes. Share prices move up and down a lot, like a lot. So that yield changes a lot. You could actually have a company go like, well, look at Under Armour. It came up on that list. That was one of the lists. And it jumped 25% in a day. Now, that's unusual. Actually, it's not as unusual as you think it might be, but that was lucky. That just got lucky. And that's what you're doing here. You're putting yourself in a position to get lucky.
Yeah. When you first explained the value model to me, it was a lot of numbers, and I was very confused. But I like to look at it like you're walking into a store, and basically this is a way of finding the best products that are on sale.
Right. Yes. Best products on sale. That's a good way to talk about that. I got to take a real quick phone call, and I got Jerry. Jerry, how you doing?
Hi, Bill. Obviously, at this point, the market has baked in what the results of the midterms will be. But long term, where do you see things? How are they going to be affected, assuming the Dems take the House and everything else remains constant?
Well, actually, we were talking a little bit about that at the beginning of the show. And
okay, I'm sorry, missed it.
That's okay. If you look historically, and I have to preface this by saying this is the way it was back when I had very thick, dark hair.
Me too.
Yeah. So
I don't have any hair now.
I'm right behind you. The strongest form of government was when there was a division of power between the president's office and Congress and Senate. So it was actually a mixed bag that ended up getting the most done. And I thought that was really cool. That was really interesting. And I think there have been very few times when you've had such an overwhelming majority ever take the House with such angst built up.
Sure.
And that is things will actually get done that way, not in a I think you need to be bipartisan. I really think you need to work together. And
I agree with that. Yeah.
And I'm hoping that I'm hoping that
sorry,
works.
but the last 2 years, obviously, we've seen a very nice movement to the up. Assume we do get split government, is there much room for upward movement? Or, I mean, I think the markets are saying, hey, we have the best of all worlds, or at least that's what they're saying now. How would going to a split government, that you'd think that would drive it down a bit, wouldn't it? Or how could it benefit it?
Well, the reality is no one's going to know until it's too late to do anything about it anyway.
Okay, it's very true. Very true.
Yeah. That's the absolute truth. So anything else beyond that is conjecture.
I would like to say that when you talk about the split government between the two parties, I think they would have been a lot more effective a little while ago when they were kind of nicer to each other. So you still might be right about today, but I think if let's say that we get a blue wave, it might slow us down. That's my opinion, but I'm one guy. And
he's
I'm
a college student, and he's very smart, and he's working at it, and so realistically, and I agree. You can't really know, Jerry. That's the bottom line. You just don't know.
Yeah.
So many things have happened.
Trying to make a decision based on a historical perspective rather than anything else. That's
bad idea. It's good to have some knowledge of what's happened in the past, but you have to be aware that there are lots of new factors that are coming into play that weren't ever here before. It's never been quite this way ever in the history. And by the way, that's always been true. You have some similarities, but man, those things, and something that works that has a high correlation of having worked in the past, it'll work until one day it doesn't.
Yeah, very true.
And unfortunately,
that's kind of a contrarian attitude.
Well, it's actually just observing life. That works until it doesn't, and so you stop.
You're right.
But anyway, reminds me of an old coach I used to have to say, how long are you going to run that play until it stops working? Until they make an adjustment? Yeah.
Okay. Well, I personally, I kind of see the market treading water at this point. I wonder, it can go up a little, it can go down more, but I don't see it going anywhere, significantly. But that's just my feeling until it does have a breakout.
Yeah, and there are lots of things that are happening that could cause that, and it doesn't have anything to do with politics. So that's the good news.
World environment, terrorism, the whole thing.
You got some stuff that's coming down like right now. That's bigger than anybody imagines. I don't know if you remember way back you've been listening for a very long time. I don't know if you remember back in 1996, but I still have the cassette tape. Okay, the cassette tape, Jerry. I saved this tape. It was from 1996 when I was beating on the table saying, you got to invest in this company. It's called Qualcomm. That was when I was young and dumb, and I would give people specific advice. And Qualcomm went nowhere. It stayed in a 38% trading range. You know why I know that? Because it was so painful for me. It stayed in a 38% trading range all the way up until 1999 when it went up 2,700% in a year.
Wow.
Okay.
Wow.
So
in 1 year?
1 year. Go look it up. Go to freestockcharts.com and look that up. Pull up a monthly chart of that.
Amazing.
So here's what I'm telling you.
Question.
No, here's what I'm telling you. The reason that I felt so strongly about that was Qualcomm was the only company in the history of the world that had ever gone from under 100 million to 300 million to 600 million in 3 years. At that time, remember that's 1996. Okay, we had a lot of inflation since then. But at that time, they were the only company in the entire world that had ever done that. And you know what? And no. You got to let me finish. You know what happened to the? You know what happened to the stock? It went nowhere. It went up and down 38% for 3.5 years. And you know why it did that?
No.
Because it's a stock. Because that's what they do. Now, eventually, value finds its way into the market. It does. And then that got hopelessly overpriced, by the way. In fact, I held on to it a lot longer than I should have. I made more money than I should have. I knew better than that. But as soon as I sold it over the next couple of months, it actually went up and doubled again.
Wow.
But then it crashed, and it's selling right around, I don't know where, it's selling close to the same prices that it sold for about 18 years ago. So that's what happens when they get super overpriced. So that's what you get for knowing, by the way. When you actually know the future, okay, that's what you get. You get to sit there and wait for everybody else to recognize what you already know. And it's rough. It can be very rough. Hey, listen, I hear the music. I'm sorry I talked too much, but give us a call back next week. We'll talk to you more about it. And you're listening to Bill Bullington. I'm here every weekend with actually Mike Cejer today, 11 to noon on 1420 The Answer. Thanks for coming in, Mike.
Oh, no problem. It's good to be here.
Thanks. No, you guys feel free to go to my website and reach out to us if you'd like to. Have a good weekend, good luck, and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.